Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us here during VRIC in Vancouver on May 18th, 2022, and I am joined by Danielle DiMartino Booth. She is the founder of Quill Intelligence. She's based out of Dallas. She's a former advisor to the Federal Dallas Reserve. Thank you so much for joining me, Danielle.
Great to be here. Loving this town.
Yes, it is, and it's not raining, thankfully. Hopefully it stays that way. Listen, it's been already just today on May 18th, an incredible day on the markets. I just want to hear what your thoughts are on what's currently happening and the larger landscape.
So, I think that I think investors right now are really confused. They're really looking for their compass because we've grown accustomed as investors to buying the dip, always come in and buy the dip. And so we're not there though right now. We might get bear market rallies, but I think investors are having a really hard time wrapping their heads around the fact that this is a bear market. And bear market rallies occur, and then by the end of the next day, you've lost more than 1,000 Dow points. This all, I think, comes down to the very recent recognition that Jay Powell is going to not be the same Jay Powell who caved to investors being crybabies and saying, no, I want to take risk, but I don't want to have any consequences of taking risk. I think we have a new Jay Powell.
Absolutely. Do you think that the next generation investor that's come to the marketplace has any understanding of what's about to happen?
No, I don't. I think that workers who think that working from home is a privilege that they've earned indefinitely, I don't think there's an appreciation for what a real recession might look like. And there's every possibility, there's every reason to believe that we actually could see in the United States a second consecutive contraction in the current spring quarter that ends June 30th. I know it's unfathomable, but there's a distinct possibility that we're already in recession and that the road to recession is being expedited by what I like to call the reverse of the wealth effect. And this is as people start to see their portfolios are not worth as much, they start to rein in their spending. And this is a world that revolves around what we are what we consume when it comes to our economic makeup. And if we're consuming less, we're going to be in recession.
As we enter potential recession, and as the Fed does continue to increase rates, do you believe that this will keep inflation at bay or it will reduce it to some effect? Do you think that they'll be successful in that?
I think that the Fed is going to be partially successful. We've already seen, for example, today, Target came out and shocked the markets after a relatively surprisingly strong retail sales figure that came out for April. I think people are starting to fade that because it's such a volatile data series and it's been prone to major revisions. But when you have one of the largest retailers come out and say, consumers aren't spending. And by the way, they were echoing what Amazon said a few weeks ago as well. And what did Amazon say right after it said, our e-commerce sales aren't doing as well. Americans are being pinched by inflation. They're not able to buy discretionary goods like they were when the stimulus checks were flowing. They said that they were going to be starting layoffs. And ever since then, Amazon has kind of opened the floodgates to the unthinkable. Because the only thing we've spoken about for the last 24 months is that there aren't enough employees. Well, there's an opposite of that problem. And that's when employees don't have a job at all.
Absolutely. I heard you on stage earlier today and you said something that was interesting. You talked about coming back to normalcy. Can you touch on that a little bit?
Again, I think it's a matter of there being risk and reward or risk and punishment. And
our generation's not great with punishment.
No, it's not. And the recent meltdown that we saw in the crypto land really did reveal the shock factor of this young generation of investors that they don't know what's happened. They're completely lost because they've only ever known things to go straight up like a hockey stick.
Yeah.
So this is a rude awakening, and we have had post-pandemic with Reddit chat rooms and meme stocks and NFTs. We've had a lot of new investors come in, and there's been a certain attractiveness to it. Because the government's giving you money, you don't have much to do, your parents aren't kicking you out of the basement.
You can do it like this.
You can do it on you can go back and forth from playing video games to investing. But they're not accustomed to what we're going through right now. And they're certainly not accustomed to the Fed not having they're back.
Yeah.
Oh, Powell's going to come right to the rescue. Powell's going to come. Sorry, it's been 42 years, but we finally have inflation, and that changes the rules of engagement of central banks, as the Bank of Canada has actually been in the forefront of showing us.
Yes. Well, I mean, so you say 42 years. In Canada, it was in the early 80s that we experienced 17 and 18% interest rates, which the next generation has no idea what that could possibly mean.
Well, they do now that they filled up their gas tank.
Absolutely. Now, I mean, obviously, every time we go through this, it's a very different set of circumstances. Do you have any thoughts on how long this could potentially last for us?
So I think that that's a good question. In the case of the United States, we've seen we've seen households really come out and spend a lot on their credit cards. So it's as if they're in denial. Well, the flip side is they could be using those credit cards to cover essential spending, because they're not able to make it paycheck to paycheck, because their paycheck's not keeping up with the rate of inflation. That's part of what's going on. The other part of what's going on is Americans became accustomed to a stimulus lifestyle. So we've seen this extraordinary increase in credit card spending, record levels in the month of March. And I think that is people living partially in denial and saying, I like that lifestyle. I'm going to maintain that lifestyle no matter what happens. And again, when you bring in the prospect of layoffs increasing and rising debt levels, it's not a good combination.
Well, there's a lot that my grandparents told me that I'm going to be reaching for as far as practices of saving food and being more cautious, right? I mean, I think we're really entering that state. Before I let you go, because I know you have to go back on stage, so thank you so much for joining me. What are you investing in today? With the markets the way they are, what attracts you?
I'm extremely defensive right now. I've always been involved directly in private kind of startup firms, and that was always the way to expose myself to risk. But in the United States, I'm loving my municipal bonds, absolutely loving them. People ask me, what position is your portfolio? I'm like, the fetal position. And I'm certainly not getting rid of any of my gold holdings at this point, because gold can be, even when the dollar is as strong as it is and interest rates are rising as they are, gold can still be a safe harbor from disruption in the financial markets, because I think that this recession could be long and drawn out. So anything that people have a choice to buy or not buy, I think that they're going to be very at risk. And stable, high cash flow, for sure they're going to make their dividend payment companies that no matter what happens, you absolutely have to buy something from them because it's considered to be an essential. I think that that's about as defensive as you can be, and the right place to be.
You also mentioned something on stage I want to touch on. You talked about the real estate market. What are your thoughts there?
I think that I really do think, and that I made my bones in housing, and because of the proliferation of investors who really have come in with somebody else's levered cash and made all of these, a third of all housing transactions in the United States are backed by an investor playing with some private equity firm's cash. And so unfortunately, that has forced many U.S. households to compete to get into the housing market at the highest prices known to God and man. The average U.S. mortgage payment's up 39% year over year. We've never seen affordability this crimped. And by the way, commercial real estate is also an accident waiting to happen, because a lot of companies have learned to do with fewer employees. And these office buildings, and we used to count cranes for fun, a lot of these office buildings are not going to refill. And therefore, a lot of very high-end multifamily luxury apartments, what are they going to do if the ecosphere around the office that we used to know downtown metro centers is not going to come back in the same form?
Well, I know in Vancouver there's a flood to leave the city. I mean, it's so beautiful outside of our downtown malls that there's definitely a flood that way. Danielle, thank you so much for your time today. I know I have to run you back on stage.
My pleasure.
But I appreciate your insights. Thank you again.
Thank you.